Hi, this is Alessio. I hope you're well, and I hope you're having a fantastic week. In this video, I want to share with you something very important. In fact, what I want to share with you in this video is one of my favorite trading strategies, and also a strategy for how to read the charts, how to analyze the charts better. So we'll take a look at the chart of Bitcoin in a few minutes, and I want to share with you what I saw on the chart of Bitcoin over the last few weeks, and also very recently, this past week as well. And here's the thing, guys. What I'm going to show you in this video is something you don't normally read about in books, or actually in a lot of material about chart analysis. So I think by the end of this video, you're going to learn something new perhaps, and also something a lot of people out there don't know about. So take a look at this chart of Bitcoin. I want to show you what I saw on the chart of Bitcoin over the last few weeks. So first of all, you can see after this major rally to the upside, we had a pullback down to the 21 moving average, the blue line you see on my chart. So we came back down, pulled back to the 21 EMA, the 21 exponential moving average, and notice we did not close below it. We held it, formed a Doji candlestick pattern, and then rallied higher to about the 19,900 level. Then we came down one more time. We tested the 21 average, the blue line. Notice we formed a kind of a hammer-shaped candlestick pattern right above the moving average there. And you can see what happened afterwards. We actually went back and retested the lows, actually dropped down, retested the lows. By the way, since then, of course, we bounced a bit higher. So what I want to share with you in this video is a specific strategy which I like to use, and also for analyzing the charts. And it's actually a strategy I first learned about 15 years ago when I first began to learn about trading analysis of the markets. And by the way, the person who taught me this was a very good friend of mine. He actually was an ex-Goldman Sachs trader. So it's a very good friend of mine 15 years ago, who actually was my main inspiration to trade. In fact, he taught me a lot of his strategies personally to me. And what I'm going to show you today is one specific strategy which he taught me 15 years ago, which I've actually improved upon today. So notice what happened on Bitcoin very recently. Notice that, again, Bitcoin came down, actually this was about a week or so ago, came down to the 21 average and formed a hammer-shaped candlestick pattern like you see there. And again, before that, again, notice Bitcoin came down to the 21 average and formed a Doji candlestick pattern right on the moving average, and then rallied higher. Now, in case you're wondering, okay, so what does that tell us? Okay, so have a look at this and notice this is actually a very typical, most textbooks tell you this. Most textbooks on chart analysis tell you that when you see a hammer-shaped candlestick pattern on a moving average, that is usually a very bullish pattern. Okay, so a hammer-shaped pattern or a doji pattern like this, either one of those can be very bullish, usually when they pull back to a 21 average. Now, again, I should tell you, my good friend who used to work for Goldman Sachs, the way he taught it to me was first you have to pick an uptrend. So the first thing you look for on a chart is an uptrend, a strong uptrend move, like the one we saw in Bitcoin recently, a strong move up and then a pullback. So you want to see a pullback on the price of Bitcoin gradually down to the 21 moving average. And in case you're wondering, can you use a different moving average? Yeah, you could. You could use whatever moving average you like. A 50 average, for example, a 200 average if you like. Okay, so here's an example for you on the chart you can see right there. So once the prices pull back down to the 21 average, a key support level, you want to see kind of a hammer-shaped candlestick pattern like you see there, forming right above that blue line, the 21 moving average, or whatever average you like. The same goes with the doji, okay? It must close above the 21 average, not below it. It must always close above it first. Now, once you got that pattern in an uptrend, then what my friend would do, what he used to do is he would go long. So essentially he would buy at the market at that point, and then he would put a stop loss at the lows of the hammer or the doji pattern. And it just basically he would go long and he would trail a stop loss higher. And I used to remember about 15 years ago, he would tell me, you know, every single day he would be trading this pattern. Now he had some great days with this strategy to make a lot of money. And of course he had bad days too, as I'm sure every trader has this. You have some very good days and also you have some very bad days, of course, as well. Now, here's where it gets interesting. The way I actually use the strategy is slightly different from the way my friend uses it. Firstly, you have to wait. I mean, most textbooks tell you this, that you have to wait for a confirmation signal. So the hammer or a doji pattern on a moving average, like we saw in Bitcoin recently, by itself is not enough. What you need after that, as you can see from here, is confirmation. Ideally, you need to see another green bar, another positive bar after the hammer-shaped or the doji pattern. Okay, some textbooks tell you this, and I think they're right. After the hammer-shaped pattern or the doji pattern, ideally you would need to see a confirmation bullish signal, or indeed a bullish or a positive candle bar after the doji or the hammer pattern on a moving average. However, guys, I've actually improved on this strategy even further. You see, guys, there is something even better you can do. And again, a lot of textbooks don't mention this, but again, I'm going to actually reveal it to you in this video. You see, you might well ask yourself, well, hang on a second. If a doji or a hammer pattern forms on a moving average in an uptrend, is there anything else that might tell you it's bullish before the next candle bar, before the next major confirmation candlestick bar? Yes, there is. What you can do is this. You see, guys, when the price of Bitcoin pulled back to the 21 average just recently, the hammer pattern that formed, I went on a lower time frame chart. And it's the key secret you want to remember. You see, guys, after the hammer pattern forms on the daily chart, okay, so this is actually a daily chart of Bitcoin on a 21 average. Then what you want to do is go on a lower time frame chart, like a 1 hour chart, or if you like, you can go to 30-minute or a 15-minute chart. But in this case, I'm going to go ahead and use a 1 hour chart. So zoom in on that hammer pattern, go on a lower time frame chart, like a 1 hour chart time frame, and count the waves on that bounce. So count the number of waves you can see on the hammer pattern. So you can see I went on a 1 hour chart time frame. This bounce you see here, this rally, is the hammer. So this rally you see here in the price of Bitcoin on a 1 hour chart is the same pattern that formed as the hammer pattern that formed the daily chart. Okay, now here comes the best part. What you want to do is count the number of waves you see on that lower time frame. Take a look at this chart of Bitcoin. So on that rally we saw on Bitcoin recently, that hammer pattern, by the way, on that rally, on the 1 hour time frame, how many waves do you count? Do you count 3 or do you count 5? In case you're wondering, what does it matter if it's 3 or 5? It matters a lot. You see, guys, I only counted 3 waves. You can see for yourself. Count the number of waves in the bounce. In the bounce, in the rally, we counted 1 wave up, 1 wave down, and 1 wave up. That essentially was a 3-wave move on the price of Bitcoin. Now, if you're familiar with Elliott wave analysis or Elliott wave theory, then you know what I'm driving at. You see, guys, if the price has been dropping and then you see a 3-wave bounce, a 3-wave move, what that is telling you is that very likely you're looking at a corrective bounce, not an impulsive bounce, not the start of a new uptrend to the upside. No, you're looking at pretty much very likely a corrective bounce. As you can see from this chart, notice price goes down in a 5-wave move, then has a 3-wave bounce. You can see from the red. The red shows you the 3-wave bounce, then another drop, a 5-wave move down, and then a 3-wave bounce. You see, guys, Elliott wave theory tells us that corrections, corrective moves, in other words, false rallies or corrective bounces are usually formed of 3 waves. Not 5 waves, but 3 waves. And that's why I went in a lower time frame chart recently, and in fact, as you can see from this chart, on the 1 hour time frame, we only had 3 waves on the bounce, on the hammer pattern. Okay, so what is it telling you? It's telling you very likely that bounce, that hammer pattern, that rally we saw in Bitcoin, very likely was corrective, not impulsive. And if it's corrective, I'm sure you understand what that means. It means very likely we're going to see another drop down to retest the lows. That essentially would mean a trader would get stopped out on something like that. All right, guys, so what I've done here, guys, is I've actually improved upon what my friend from Goldman Sachs was trading upon. So my trader friend from 15 years ago, he only would take the hammer pattern as it was on a moving average, in an uptrend, of course. But what we're doing now with this pattern is improving it, actually increasing the probability of it. What we're doing is going a lower time frame and counting the waves. We can see we only saw 3 waves, which is telling us, you know what, that's probably just an ABC corrective move, not a 1, 2, 3, 4, 5 in an impulsive rally. By the way, you might be thinking to yourself, well, hang on a second, Alessio, what if that was actually 1, 2, 3? Couldn't that be 1, 2, 3 in an uptrend? No. Here's why, guys. Because that 3rd wave, you can see there, in Elliott wave theory, wave 3 can never be the shortest wave. If that really was a wave 3 in an uptrend, it couldn't be, because wave 3 is never the shortest wave. Wave 3 can never be the shortest impulse wave. All right, guys, so that's why that could not have been a 1, 2, 3. It had to be an ABC, very likely. So guys, what that means is this. Anytime you see a bounce from a moving average or a support level, go in a lower time frame chart, count the number of waves you see on a lower time frame, like a 1 hour, 30-minute, or a 15-minute chart, whatever you like, really. And on the lower time frame, we only counted 3 waves, which told us very likely we're dealing with a corrective bounce, a corrective wave, not an impulsive 5-wave move, which could mean it's going to go higher. No, it was a corrective bounce, which could mean we could very likely go ahead and retest the lows that we formed on Bitcoin, which we did, by the way. In fact, Bitcoin went down and took out the lows it made very recently. And guys, before I finish the video, I just want to say something very quickly. My good friend Charlie Burton, who's a fantastic trader, as I mentioned previously, is giving you a free month, a free first month of his Signal service. And by the way, this free month offer will not be there forever. So if you want to take advantage of it, then make sure you do so as soon as you can. And also Charlie is offering you a 40% discount on his Signal service when you use this promo code. You can see right there, Bravo1. And for more details, go ahead and watch Charlie's video, which explains everything for you on that link right there. And guys, let me just say thank you very much for those of you who've already joined Charlie's service. I do appreciate it. And guys, as I'm sure you're aware, trading carries a significant amount of risk. So make sure you always use a stop loss and please do not over leverage either. Thank you very much indeed. Bye for now.